Welcome to Taking Stock for the week ending the 1st of October 2021, where today I have the pleasure of welcoming Tim Lincoln, our Managing Director and Chief Investment Officer, who's joining me, Kien Trinh, to stream to you all things share market. Welcome, Tim, and congratulations on your recent appointment to the board of the Carlton Football Club.
Oh, well, thanks, Ken. Yeah, obviously very proud, and it's certainly a privilege to be a director of the mighty Carlton Footy Club. I actually feel like I'm wearing the jumper, and but a bit of a boyhood dream actually. And I'm on the board now with Greg Williams, who was one of my heroes as a young fella too. So I feel like I am real part of the team, which is a wonderful feeling, of course. But it's great also that I believe we'll be making a purposeful contribution to the Mighty Blues in regard to applying our data analytics and our methodologies to increase the probability of successful outcomes via objective decision-making processes. So, yeah, at least I'll be adding real value together with it is a wonderful privilege.
That's right, Tim. It's all about the passion, isn't it? And talking about the passion, we've invested so much in Stock Doctor, and Stock Doctor is celebrating 25 years in the market since its launch in 1996. And it's incredible how our technology has evolved over time, Tim.
Yeah, and hasn't time flown, Ken? 25 years, can you believe it? But very proud, and once again, I'm sure Dad would be too. And we found a beautiful photo from our archives there where I think it must be only 6 months after we launched Stock Doctor or so. Yeah, where Dad and myself are proudly in front of our first version of Stock Doctor. But yeah, it's also very proud of the fact that we've achieved such longevity. We've seen many of our competitors and fly-by-nighters come and go, and it's a huge thanks to our members for their loyalty and confidence that they've had in Stock Doctor, of which many of those members have been with me for the entire journey. And we may be not able to celebrate 25 years because of COVID, but look out for our 50th year anniversary, Kian. That'll be one big party. And you never know, we may have a global platform then driven by artificial intelligence and machine learning, or the next form of intelligence. Who knows what it'll be in 25 years' time, or even a universal product if galaxies have financial markets. Who knows? But back to our organic growth strategy, one step at a time. Yeah. And to the present, Kien. Over the last month, over the last 3 months actually, we've seen a real swing back to quality growth in income stocks. And it's moved away slightly from perceived value, where investors can get caught out in low quality value traps. And often those low quality value traps trade cheaply for good reason. And we've mentioned that quite extensively over the last few months. So the swing back to quality obviously benefits our star stocks and, of course, our members' portfolios. However, the market has been quite volatile during September, one of the choppiest months we've seen in quite a while, with the All Ords down around 1.6%, but even choppier in the US with the S&P 500 down around 5%. The last time the market experienced a decline like this was ironically back in September last year. But having said that, Kien, the All Ords is up around 29%, the S&P 500 in the US up around 32% since that time. So it's been a terrific 12 months for investors during a crazy environment. Therefore, vitally important that investors not fear the current bout of volatility that we've experienced over the last month, but rather embrace it, as opportunities can open up in very attractive, with oversold quality star stocks. I generally don't get too excited until we see that 10% drop in the market or 10% drop in star stocks. So we've keenly got our eye on those particular thresholds being breached. But Kian, much of the opportunity has been driven by major resource stocks like BHP, Rio and Fortescue. What's contributed to this, and are these stocks at risk of cutting their dividends in the not too distant future?
Well, Tim, we've removed these bulk commodity stocks from our growth portfolios, but have retained them as star income stocks. And despite the decline in iron ore prices, these companies continue to generate positive free cash flow, a metric we use to assess the sustainability of those dividend payments. And while we feel consensus analysts are likely to pare back their dividend forecasts, the gross dividend yield for these companies should remain well above the market average. And again, all that volatility, there are several factors that have driven that market volatility. And the most prominent here is the fears that there's in China, the second largest property developer, Evergrande, they may default on their obligations. And this could spread to other creditors like the banks, resulting in a potential fire sale of their assets and also trigger a contagion effect. Now, analysts believe the property market could contract by about 10%. And this could have spillover effects on other parts of the economy, including steel consumption. That's why iron ore prices have fallen quite a lot. But we believe these risks are manageable, and the Chinese government are able to intervene as well. For example, they've been injecting plenty of cash into the banking system. Meanwhile, those creditor banks can also absorb Evergrande's debt because it only represents about 3% of their total bank profits from the last year as well. But other reasons for the market volatility also include, you've got power outages in China and fuel shortages in the UK, which has added to fuel inflation fears, leading to higher bond yields. Also, there's concerns that the US will suspend its debt ceiling as well, and failure to increase its debt limit could mean that the US will have to default on its debt obligations, and that could lead to a financial contagion.
Yeah, those debt issues with Evergrande and the US government remind us to be vigilant in managing our portfolios, doesn't it, Kien? Despite low interest rates, the threat of insolvency is real. And that is why financial health remains at the forefront of our stock selection process to avoid those risks of total corporate collapse. But really exciting times for us. We've been optimizing our star growth stock model and actually employing that out to market, which is so exciting and so positive after such a long period of testing, Kien. We made sure that companies needed to be financially healthy for 2 consecutive periods. So back to the importance of financial health. Our financial health model has helped us manage portfolio risk during down years, obviously. As you can see in the chart, both our current and optimised star growth model, our new one, has outperformed the market during negative market years, which is terrific. So we can absorb that volatility through the new optimised model, even better than we were previously. Our optimised model in the light blue, the current model in the dark blue, and the market performance in the grey certainly represents that incredibly strongly. So after all of that period of testing, Kien, the results are incredibly positive and our Stock Doctor members stand to benefit. Also importantly, our optimised model outperformed the market in all years but one since the GFC in 2008. So further consolidation that the models are working beautifully over a sustained period of time. From a Stock Doctor perspective, we are currently transitioning our growth portfolios towards the optimised model. So as we ask for patience over the next 2 weeks as this transition occurs, as a result, there will be temporary increase in the portfolio turnover, the number of star stocks that are transitioning. However, we believe this change is necessary to ensure our star stock portfolios are dynamic enough to adapt to the COVID environment and beyond. The managed fund team are also busily transitioning the Lincoln Australian Growth Fund to the new optimised models as well. Just as a reminder that the growth funds require high levels of liquidity, as under Golden Rule 6, so it'll have a combination of liquid star growth stocks and borderline star growth stocks to build out a diversified portfolio of around 30 stocks. For income investors, we will not be changing our stock selection criteria for star income stocks, because to confidently ascertain whether a dividend yield is sustainable requires quite a large qualitative overlay still that will be adhered to by our analysts. So really important little point there. We tested our income models, but found that large qualitative overlay was still really important. Of course, our analysts with the growth stocks will continue to share their knowledge and be happy to speak with our members if they ever have any questions around the new model or the stocks that they cover.
Yeah, thanks, Tim. And talking about analysts sharing their knowledge, one of the key themes that's still emerging across the market is the merger and acquisition activity. And this time, our recently covered star growth stock and star income stock salary packaging company, Smartgroup, they received a takeover bid from private equity TPG and Potentia Capital. Now, Smartgroup shareholders would receive $10.35 per share, but that will be reduced by any dividend, although they will be able to keep any franking credits prior to the transaction date. But even at these levels, Smartgroup's gross dividend yield is still well above market at around 5.6%. Not surprisingly, its peer stock, McMillan Shakespeare, has also performed well on the back of this. But Smartgroup sparked private equity interest because it has a simpler business model, mostly in novated leasing and salary packaging, and this has led to higher profit margins. Meanwhile, McMillan Shakespeare is exposed to finance broking services, which is also weighing on its profitability.
Yeah, and it's so it's great to see that Stock Doctor members who held a position in Smartgroup would have done really well during the week, cushioning some of that volatility, as did the Lincoln Australian Growth Fund, because we held a full weight position in Smartgroup as well, helping the fund to cushion some of that volatility during the week when so much money was flowing out of the growth stocks and tech related stocks. So that was really nice. And it's also really encouraging to see that the chairman and CEO both have a bit of skin in the game, of around 1.8 and 1.1% of total shares on offer between the two of them. So nice to see that skin in the game, Kien.
Yes, Tim, and on the theme of M&A activity, another company we initiated coverage this week was billing software provider Hansen Technologies. Now, Hansen provides billing software and services across the energy, water and communication sectors. And interestingly, prior to coverage, we noticed that private equity firm BGH Capital, they withdrew their $6.50 per share offer following due diligence. And although this raises a red flag, the CEO and founder Andrew Hansen stated that nothing came up anywhere during the due diligence process to suggest any black holes. Unfortunately, BGH has not publicly commented on this decision. But despite this, when you look at through Stock Doctor, earnings quality is strong, and the company generated a return on equity of 21% and very high margins at 18%. So the share price weakness provided an opportunity for us to jump into a defensive technology company at quite a reasonable price.
Yeah, and you mentioned Andrew Hansen before, Kien, and we've liked Hansen over many years. They've sort of been in and out as a growth stock quite a few times over the years. Good to see they're back in again, and it's also great to see that Andrew has a significant stake in his business that he founded many years ago at 17.5%. So again, love that skin in the game, Kien.
Yes, so now turning our attention to the corporate calendar, there are no star stocks reporting next week. However, we have Baby Bunting and Brambles. They'll be hosting their AGM. And then there's ARB Corporation. They'll be going ex-dividend on the 7th of October. Meanwhile, for technical indicators, those trend-sensitive investors, there were no technical changes observed during the week on the SD Max or the SD30 Star. For Under the Microscope this week, we divert our attention to a retail-focused bank, MyState Limited. Now, the bank has a higher gross dividend yield than its bigger peers, and that's to compensate investors for being a smaller player with greater operational risks. For example, it faces higher wholesale funding costs and greater competition from the Big Four. Also, the regional banks, they typically have smaller loan books than the Big Four, and this increases the risk of loan defaults because the risk is spread across fewer borrowers. Positively, though, the company reported minimal changes to its provision for bad and doubtful debts over the year, and this should help support the gross dividend yield of 8.8%. The bank recently raised $55 million to fund its growth strategy, including the significant upgrade to its front-end user interface and to improve its digital back-end processes. But you might be wondering why MyState just didn't reduce their dividend payments to fund these investments. Well, last year, a total of $11.7 million in dividends were paid, but they raised $55 million in capital. So cutting dividends would still mean there'll be a large cash shortfall. But management would rather tap into capital and debt markets to fund growth initiatives because debt is currently very cheap, and reducing dividend payments often signals management lack of confidence in the future operating environment. But the capital raise is expected to dilute earnings in the short term, with return on equity and earnings growth expected to decline significantly this year.
I think it's really important to point out too, Kien, that under Golden Rule 3, we identified there that only one analyst is contributing to the forecast. So that's a little skinny for us. We generally like to see, at least 3 or 4 contributing, so we get that more robust consensus contribution there. And also being a borderline star growth stock and a star income stock, obviously it represents good opportunity for both the income and growth orientated investor. And it is really worthy of consideration if you're prepared to take that little bit of risk on in regard to the skinny coverage in regard to forecasts, because of their such high return on equity and great net profit margins. And of course, for income investors, really attractive yield. But unfortunately for both the Lincoln Australian Growth Fund and the Lincoln Australian Income Fund, we can't invest in MyState because there's simply not sufficient liquidity available under Golden Rule 6 for us. So yeah, it's one there purely for the Stock Doctor member to enjoy.
So with increasing market volatility coming through over the last couple of weeks, a useful question for investors this week is, how do I protect my portfolio from periods of market volatility? And our Stock Doctor platform, it provides that useful framework for you to manage share market volatility. Firstly, you should have enough stocks in your portfolio to eliminate systematic or market risk. And you can do this by using our portfolio manager and optimizer. You should also monitor your stocks closely under Golden Rule 4, share price sentiment. Take profits off the table on stocks that have risen too hard too fast to avoid over-concentration risk. And you can use this accumulated cash, which improves your defensive position as the market continues to rise and allows you to look for star stock opportunities when there is a market correction. And if you are trend sensitive, then you can apply the SD Max or the SD30 TSR or one of your own technical indicators to help you buy and sell stocks. Last but not least, you should invest based on your risk tolerance and time frame, meaning would you be comfortable if the market had a 50% correction tomorrow?
Yeah, and I think I'll chime in there, Kien, and just provide a little bit of insight into what we're doing for managed funds at the moment. Now, we're currently sitting in all 3 portfolios, being the Lincoln Australian Growth Fund, Lincoln Australian Income Fund, and the 2 US growth funds, one being hedged and unhedged, of course. We're sitting in a roughly around 6 to 9% cash throughout those portfolios. So we're not overly concerned about volatility, hence why we're carrying that fairly low cash position. And we're opting now to be as fully invested all the time as we can, but we'll encourage investors to consider during times of volatility for them to take advantage of that and perhaps increase their own inflows into the fund to embrace where unit price may actually be a little bit suppressed. And personally, that's what I tend to do from a personal perspective. So that's where we're sitting at the moment. And the markets have only corrected, around that 5% level. So it's nowhere near that opportunistic point of greater than 10% correction that I tend to look for anyway. But with the Lincoln Australian Growth Fund, I mentioned earlier too, that we're in that transition phase to the new model. We're just about there, actually. We've had to trade a lot. New stocks come in and a few go out. So I think we've traded close to $300 million over the last 2 weeks. So a lot of activity there. The Lincoln Australian Income Fund, because we're not transitioning to a new model, we're now gearing up for a wonderful distribution period coming up. This last quarter has been a terrifically strong distribution period for investors, with major companies like BHP, Rio and Fortescue boosting dividend payments in the way of special dividends. And also there's been record buybacks and the like occurring too, which has been a wonderful boost for the income style investor. The US Growth Fund, we've had a wonderful start. We couldn't wish for better 12-month returns since launch back on July 1 last year. But yeah, we've copped it a little bit over the last month because of that high exposure to high tech in the US portfolio. But all portfolios have greater than 30 stocks in it, so we don't have over concentration risk. We've got beautifully diversified portfolios that are able to cope with the latest bout of volatility.
Thanks, Tim, for your insights today.
My pleasure, Kien. It's always a pleasure sitting down once a month with you and embracing this beautiful opportunity. Also encourage our members to have a read of my quarterly message that was distributed to members yesterday. So have a read. A lot of the points we've covered off on today are also reinforced in my quarterly message.
Yeah, thanks, Tim. And the key message from today is don't fear volatility. You've got to use it to your advantage and take advantage of this opportunity to buy into quality businesses. And Stock Doctor does have a raft of tools to help you identify those quality stocks. As Warren Buffett once said, be greedy when others are fearful. Take care and have a happy, healthy, and prosperous week, everyone.